Well, greetings, Series 6 test takers. I'm Colin Kleck, coming to you from our studio in colorful Colorado. This is our video series on the Series 6 exam. During this session, we'll do an overview of annuitization, looking into payout options and the assumed interest rate, the AIR, and how performance of the subaccount affects that payout. So when an investor annuitizes, they basically take all of the money from their accumulation phase and they exchange it for a lump sum of money for the rest of their life. So in order to make this payment out to the investor, we take a look at two things: the assumed interest rate, or the AIR, which we're going to cover in detail in the next slide, and we also take a look at payout options. There are 4 specific payout options that we list here. With straight life payout, it's the highest payout to the investor because there's no beneficiary on their annuitized contract. So if the investor passes away early, the insurance company keeps any money that's left in the annuity. With a life with period certain annuity, we usually establish parameters, whether it's 10 or 15 years for a period of time with a life period certain annuity. If the investor, the annuitant, dies within that period certain, their beneficiary will keep getting the remaining payments. So if I have a 10-year period certain and I'm dying in year 2, my beneficiary will receive payments for the next 8 years. With unit refund life, regardless of the time frame, if there is any value left in the annuity units, that value will be transferred to the annuitant's beneficiary. Finally, joint and last survivor. This is a way for us to have 2 owners on the same annuity. With the assumed interest rate, it is a fixed percentage that never changes, and it is just a benchmark. So we take a look at our subaccount value and that performance of the subaccount to figure out how our performance compared to the assumed interest rate to get a payout every single month. If it's higher than the AIR, the payment's going to go up. If the payment is less than the AIR, the payment's going to go down. So let's take a look at our assumed interest rate and performance. The payout from our variable annuity is going to fluctuate even though the assumed interest rate is fixed. So if our portfolio has an actual performance that's equal to the assumed interest rate, the payment in dollars for the current payment of this month is the same as the last payment. If the actual performance is higher than the assumed interest rate, the payment in dollars this month will be higher than the last payment. If the actual performance is lower than the assumed interest rate, the payments for this month will be lower than the last month's payment. So the payment in dollars ends up being a rolling number out of the annuity. So let's do this quick example. I have my annuity here. It has an assumed interest rate that is 5%. In the first month, I received $1,000. That's excellent. We're all happy. Then what we do is we look at February, and all I care about is the performance to the assumed interest rate. Is the performance higher or lower or the same as the assumed interest rate? Well, it's 7, so it's higher. So your payment according to the benchmark rate should be higher than the last month payment. So then in March, we don't care about February. We've already been paid. In March, take a look. All we care about is this assumed interest rate and the actual account performance. And what we learned previously is that anytime the performance is higher than the assumed interest rate, my payment will be higher than the last month payment. It's a rolling number. But Colin, I got a higher payment in February. Yes, but you've already been paid for that. We're going to give you a new level to hit. Once you've been paid for March, then we look at April. The assumed interest rate and our performance are the same, so the payment is going to be the same as the last month's payment. But what if the performance is lower, right? So we're going to still start off January. Our assumed interest rate and performance are the same. The investor gets $1,000. Now in February, if our performance is it higher, lower, or the same as the assumed interest rate? Well, it's lower, so the assumption is that your payment in February will be lower than the last payment in January. We've been paid for February's, so now we take a look at March, and all we really care about again is the assumed interest rate and the performance. They're the same, so your payment in March would be the same as the last payment, $980. Then in April, let's look at this. Your performance in April is lower again than the assumed interest rate. So your payment in April will be lower than the last month's payment, $980. So whenever you think about a payment out of an annuity, that payment in dollars ends up being a rolling number. It changes in accordance with the benchmark rate. So we did an overview of annuitization, looked at the payout options and the assumed interest rate, the benchmark against the performance in the actual account, and this concludes our session for the Series 6 top-off exam. We'll move forward into our next chapter. Do simulated exams on millionairesintraining.com and practice thoroughly until you can get high scores and pass our tests. You're doing fantastic, and I'll see you in the next chapter.